I'm Rishika Bhamri, so I'll be starting with the presentation. So, this presentation is about how income from house property is taxed under Section 22 of the Income Tax Act. We'll go step by step to understand the types of properties, how income is computed, and some special cases like unrealized rent and errors. So, the next slide is types of house property for taxation. So there are mainly three types of house property for taxation. First is let out property, always taxable no matter how it's used. Second one is self-occupied property. If it's used for living or for own business profession, it's exempt. Up to two houses can be treated as SOP. Third one is deemed let out property. If you own more than two houses, the extra ones are treated as let out and taxed. So the third slide is computing income from house property. To compute taxable income, we follow three steps. Gross annual value. So we compare municipal value, fair rent, standard rent, and actual rent. Second one is subtract municipal taxes, deducted only if paid by the owner. Then we apply deductions under Section 24, includes a 30% standard deduction and interest on borrowed capital. After these steps, we arrive at the taxable income from house property. The fourth slide is interest on loan which is under Section 24 subsection B. Interest on loans for purchase, construction, repair or renovation of property can also be claimed as a deduction. For LOP and DLOP, there is no limit on interest deduction. For SOP, the general limit is Rs 30,000. But if the loan is for purchase or reconstruction, but if the loan is for purchase or construction taken after April 1, 1999 and completed within 5 years, the limit increases to Rs 2 lakh. Also, pre-construction interest can be claimed in 5 equal installments. Fifth slide is unrealized rent and errors. Sometimes tenants don't pay rent or errors are received later. Unrealized rent can be deducted if the tenant is genuine, has vacated, isn't staying in another property of the same owner, and reasonable recovery steps were taken. Errors of rent, Section 25A. Taxable in the year of receipt, but only 70% is taxed since a 30% standard deduction is allowed. So, unrealized rent reduces tax and errors are taxed when received. Thank you.
Hello, I'm Kavya Jain, and this slide covers two important concepts. First, if a house is vacant for part of the year, then the gross annual value is adjusted. It is compared with the expected rent and whichever is lower is taken. Second, if the property is partly let out, like in case of area-wise, expenses like municipal taxes and interest are divided in proportion to the area. In case of time-wise, even if the property is let out for a single day, the whole property is treated as let out for the entire year. But this slide is about multiple SOPs and joint ownership. If an SSE owns more than two self-occupied houses, then they can choose any two as self-occupied. The remaining houses will be treated as deemed let-out properties. In case of joint ownership, the income from house property is first computed as usual and then divided among the co-owners according to their ownership share. Each co-owner gets a separate deduction limit of 2 lakh rupees for interest on housing loans. So this slide is about composite rent. Composite rent means rent received not just for the property but also for additional assets or facilities like furniture or parking. If the agreements are separable, then the rent for house property is taxed under income from house property and the rest under business or other sources. If inseparable, like in the case of hotels or theaters, then the entire rent is taxed as business or other income. Deemed owner. This slide explains situations where a person is not the legal owner but is still treated as the owner for tax purposes. Examples include transfer to spouse without adequate consideration, transfer to minor child except a married daughter, members of cooperative societies, holders of impartible assets, possessions given under part performance of a contract, and long-term leaseholders for more than 12 years. Finally, a few key points to remember. If property is held as stock in trade, like a builder's unsold flats, the annual value is nil for 2 years from completion. Under the new tax regime, interest deduction on self-occupied property is not allowed. Exemption for self-occupied property is only available to individuals or and HUFs. Even municipal taxes paid to foreign authorities are allowed if the foreign house income is taxable in India. Thank you.